Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So when would you use spreads then? Do you look at volatility to try to ascertain if spread trading would be better, or, what's your view on that?
Well, a lot of guys like to buy the spread, of course, and I kind of like to leg into a spread, if you know what I mean.
Sure. Can you explain that to the attendees, because they may not?
Yeah, okay, let me see if I can bring back an example here.
That'd be great. So you have a view, you think the dollar is going to rally, so you're going to be buying a call at some point, whatever. Find one where we're looking for a bottom there. Maybe that one, yuck, I don't know.
Yeah, okay. So for example here, obviously, if you want to do some kind of a spread and you want to have help paying for it, you'd probably want to try to buy a pullback to the 94 area.
Right.
So you'd want to buy your call so that you have the upside. Okay, you want to probably sell a put below there, and if you do sell a put below there, then you probably want to go at least, let's say, 92, and then maybe buy a little protection again. You can even do 90, whatever. The farther out, the better. But now, what about on the upside here? So I really don't have very much to stop price from rallying up to this 99 level. So I'm hesitant at this point to actually do a 95-99 spread like most people would do. I'd rather let prices get closer to that 99 area before I would do some other kind of a spread.
So in lieu of selling the original call you bought, you would sell a 99 call when yuck rallied up, when the dollar rallied up to 98 or 99. You take advantage of higher prices by not selling the original option but another one.
Exactly. And by that time, of course, now volatility's in my favor too, because prices are moving up.
If it's moving quickly, yeah.
Yeah, it's moving quickly, especially if it's moving quickly. But you have to be really, really confident in doing this strategy. And then again, too, it's just a matter of doing it over and over again and getting more comfortable with it. And then a lot of guys, though, they like those, like Google happens to be one where, they know Google's going to make a move up, so they're always doing a spread $10 above and $10 above that. And I just really don't see the point, because with what we're doing, it's more directional, and with what they're doing, it's pretty much not focusing on direction.
Right. So they're hedging themselves maybe a little bit too much, at least in your viewpoint. Michael has a question. He says, I don't know if this is actually correct, but he says that, and maybe you would know this, Steve, 70% of all breakouts are false. How do you guard against that? And again, I don't know if that's true, but that's what Michael's saying.
Well, Michael's got a good point about breakouts being false 70% of the time, but in the currency markets, you can kind of switch your odds around a little bit by the time of the day that you take the breakout. So in other words, what I encourage students to do is use a 4-hour chart. And when you use a 4-hour chart, that'll keep you out of trades during those quiet periods. And if you're using 4-hour highs and 4-hour lows, usually when prices do break out of those channels, it'll be a serious breakout and at approximately the right time of day, either the London session or the U.S. session. 70% of all breakouts fail in any other session besides that, but 70% of the breakouts that happen during the London or the U.S. session are usually successful.
Well, that's interesting. Yeah. So watch the major hours. Larry has a question. What criteria do you use to draw the support and resistance line? So I've seen people, and now I guess it's with computers. Sometimes I see these software packages draw lines that I don't even know how they draw them. I always looked at lower lows, higher highs, but can you just really just define how you would draw the support and resistance lines?
Well, hopefully, I saw some people typing in here. They couldn't see my cursor. Hopefully, everybody can.
I think so, yeah.
Okay, so this little base up here where we went sideways here and we declined below there, I pretty much, there's a couple of places you could place the line. You could either place it on the lowest low here.
Yeah, I can't see it now, unfortunately. Steve, you got, yeah. Did you click on one of those icons on top?
Let's see. Oh, geez, that's a shame if that happened.
Yeah.
Let's see if this is the area. Well.
Unfortunately,
Yeah.
Yep.
Let's try.
Different color or whatever.
Here.
Yeah, there you go.
Okay. This is the area that I'm actually looking at, this little, whoops, and it's going away now. It's right there.
There's, yep.
Okay, what I would do is you could put your lower line on the lowest low of this little area prior to the decline candle, and then you put your upper line on this pivot high. So that would be where your stop loss would go. A lot of people put the lower line across the bodies of the candle. That's fine too. Either way, and then you let price come into the area. And you can look for confirmation. For example, maybe you get a candle that closes in the area and the next one closes below the low of that candle. That would be your confirmation. There are sellers up there. Then buy your put. It'll still be pretty cheap.
Good point. Good point.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.isc.com/podcasts.